This will accelerate both the de-dollarization and the revaluation process.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hello, and welcome back to Live from the Vault. My name is Craig Hemke. I'm sitting in for the usual host of these great Live from the Vault videos, Shane Moran. Shane is under the weather and unable to host this week, and so I get to take a turn in his chair trying to fill his shoes, which is hard to do. This is a great show. If you watch every week, you know they uncover the truth about the global markets, the global economy, and they do so by the work of my good friend Andrew Maguire, who studies the markets and knows the global precious markets better than really anybody else I know. He'll join us shortly, and we'll pull back the curtain on the intricate world of the gold and silver markets, and we'll let you know what's happening. It has been a very volatile month, and that volatility is going to continue. So get ready for another action-packed episode of Live from the Vault. We'll bring you all the knowledge and understanding that the mainstream media just simply doesn't provide. So just before we head over to the UK and hear from Andy, help us out a little bit. We want to cast as wide of a net as possible, and the easiest way to do that is for you to hit the like button or the subscribe button. That may seem like just a small matter, but it's not. It really helps in the distribution of this information. That's what we all want. We want as many people to get the truth about the precious metals as we can. And so with that, let's head over to the UK and start talking gold with my good friend, Andrew Maguire.
Thanks, Craig, for stepping in. Really appreciate it, brother. I know that you're standing in to help poor old Shane out. I know he was back in the hospital. Sending all our blessings to him. Get ready, my friend.
Okay, Andy. 2 weeks ago in your last market update, it was July the 12th, you were mentioning and showing some charts about option expiration here later in the month. And you mentioned how the COMEX option expiration structure looked kind of bearish. You contrasted that the Shanghai operation structure, which looked kind of positive. And you thought maybe once we got through the COMEX option expiration on Thursday the 25th, that the market might start stair-stepping higher again. All right, so that option expiration is behind us. What are your current thoughts? What do you see now?
The idea really was to step back from the very short-term chart chatter to assess whether this incredible paper to physical divergence would provide us an opportunity for us mere mortals to tailgate the competing central bank buyers who are busy alchemizing paper dollars into physical gold at a pace we've never seen. And obviously into these gifted synthetic discounts. We look at this not so much from a trading perspective, but to assess a closing window for us to follow these central banks in protecting our wealth as well. Now, sometimes a picture is better than 1,000 words. So before we look at some other pertinent subscriber questions, in answer to the subscriber questions you opened with, let's look at the underlying physical market footprints we see actually developing shorter term and why every first-tier liquidity provider sees gold at $3,000 by year end, or at the very latest early next year. So having received positive feedback about the charts we presented last time, and at your request, guys, I've been sharing here, I'm going to share here what I just recorded live just a few minutes ago. And you'll see the charts developing as we go through them.
So I'll start with gold. Now I've stripped down these charts so that they're not full of clutter, so we can better see what's going on. So let's kind of look at last week's COMEX-driven action in gold futures, and this is the futures contract, the August futures contract, where we saw into the three sessions, trading sessions here, here, and here, we evidenced an all-time high, spot gold high, being printed at 24.8025, which is 24.8840 in futures. And that was into strong central bank physical demand related to the Asian trade, followed by another well-attended Loco London PM fix on Thursday. which was again attended very, very strongly. However, the moment London fixed, London, Europe, and the FX markets cleared for the day, look, the Fed sellers moved in setting up an extremely aggressive official gold intervention. And of course, capitalizing on extremely thin conditions, on illiquid paper market conditions. Now, these timed Fed-induced official interventions reveal a weak hand, and as we'll explore shortly, they're not going unnoticed by central banks, looking at exactly what we're illustrating here today. Now, I'll just condense this chart up a little better. Now, since the beginning of the beginning of July, we've seen 150,000 lots of fresh gold futures open interest. Let's call them the casino chips. And that represented 467 tons of 4% backed gold, which CTAs had accrued since the July trading had commenced. So now, of course, this was the sole focus of the official rinse target, which commenced here. Now, keep in mind that the Fed interventions look dramatic, but the scope of these wash and rinse cycles are limited to how many CTAs can be wrong-footed so as to not expose the Fed to delivery obligations they cannot fulfill. Now, into this wash and rinse cycle, where we saw the bulk of the CTA, the momentums coming on board, adding this open interest, really accelerating the addition of open interest, and that by about another 60,000 lots, or nearly 70,000 lots of open interest. Following this rinse and look as to what they've done, and what they've done is this is the gap close position. This is when most of them came on board. This is what was rinsed. So they did actually front run that getting touched. And while the open interest won't appear to have been reduced that much, this is because due to the addition of momentum-driven naked short selling, which picked up on the way down, don't forget momentums are not happy sideways. They're either naked long on the way up or naked short on the way down. And guess who is on the other side of that trade on the way up? It's the commercials on the short side, and that is really, again, not the bullion banks who are long for their own book. This is the agent bullion banks getting ready for a rinse. And of course, this is exactly, and you need power, you need position concentration to be able to do this into a strong physical market. So while we saw that rinse out here, it won't necessarily have rinsed out all of these positions. It has rinsed the long ones out, but as these CTA sellers come in, then we have the commercials on the long side of those trades. So the open interest doesn't appear to have reduced by that much. However, in typical OPEX wash and rinse fashion, CTAs will realize too late they're being set up for an upside rinse, a short squeeze. So let's pop over to the 4-hour charts to take a little bit of the chart chatter out. And if you remember, last time we talked about the two Fed interventions here. Here's where the Fed intervention came in, and guess where we bounced? So in other words, it looks like we're forging a new higher stairstep. So into the period where CTAs chase the long side with the Fed agent banks 1-to-1 on the short side, what is missed by many analysts is that while these synthetic COMEX-centric CTA long positions are only 4% backed, following the Fed's misstep in overshooting the identified central bank bids we'd identified back down here at 2,000, remember we looked at this before, and that was into the February options expiry, forcing them to buy physical at market to fulfill central bank delivery obligations they did not have sufficient CTAs to short cover into to offset their backfiring short sales. So in essence, they're really restricted to how many CTAs they can suck in before exposing themselves to physical delivery obligations. This was a breach of the 2000 level. What did that do? It forced a $450 rally with freshly unbacked CTAs enjoying a free ride, actually, without getting rinsed out. This is a change in behavior. Now, what we're looking at here very quickly, we're looking at each of these cases are options expiry events. And where do you think we are here? Another options expiry event. So it's a synthetic chase. Now, this is where the SHFE contract kicked in. So we'll talk about that. We talked about that last time. So when these kind of situations happen, and we've just did breach support, a spot support central bank bidders at 2,400, what happens here and what's happened every time is that into each of these wash and rinse cycles, the Fed is forced to buy gold at market to fulfill backfiring delivery obligations. And of course, this is on the 1st of March. The Chinese futures SHFE exchange was open to citizens who are and unlike the Western-facing actors, these actors are betting on a government-backed higher gold price, meant that the COMEX CTAs have been partly responsible for the velocity all this time of the gold rally. This is an interesting situation, because while the physical markets are increasingly setting the gold price, rinsing out these tailgating unbacked longs has become much more difficult, as it is seen into every subsequent bearishly based OCC COMEX options expiry. We talked about those in the past. The OCC bets are FX related and in the billions, and the COMEX options are also related to that. So each time we see these wash and rinse cycles, it is to protect these derivative bets. And in this case, they've been rallying from the June options lows. But little do they realize they're unknowingly underpinned by strong global central bank buying, whereby last Wednesday, so strong was the upside momentum, it risked driving a higher physically anchored stairstep at 2,500 spot, being crystallized. And that would be a full week ahead of the mark-to-market event tomorrow, which is options expiry. It came very close. And once certain levels get overcome, then the central banks come in and accept those as the floor. While into a raid, they'll just sit back and quietly take what's on offer. Why wouldn't you? If central bank bids had been filled at 2,500, which is pretty much this related line this directly related to this line here, this would have, and ultimately still will, become the next higher base rally point. And once it does, there'll be little in the way of $3,000. Now, we'll look at the reasons for that shortly, but had the Fed not stepped in last Thursday and Friday, 2,500 spot would have been set as support ahead of tomorrow's imminently expiring very large OCC FX bets and directly related COMEX bets against gold, but made between 2,350 and 2,400. Now, the OCC side of these bearishly structured bets are in the billions, and given they relate to technically NSFR compliant FX gold, one can see the robbing Peter to pay Paul predicament the Fed is in. It's the Fed, the only central bank left betting against gold. Now, a lot of these bets, so this is the daily chart, and if you remember, we looked at sideways up, pullback, sideways up, pullback, and we hadn't seen that pullback yet, but we did suggest we would see something similar. But a lot of these bets were made right around about here. And so when gold would have been in the 1900s, let alone 2,300 and 2,400, that very short-term officials, what it's doing is seeing that these short-term officials are on a slippery derivative slope, feeding bullion into the hands of every other central bank racing to accrue bullion ahead of into the October launch of Glasniev's gold-backed currency. Now, while this 100% COMEX-centric, extremely counterintuitive official intervention was obvious to us, it was also obvious to real physical market actors who, while not price-sensitive, moved to lock in COMEX EFPs and T+1 spot index orders into the lower band of the Fed's wrong-footed OPEX-related discount, which we see is here. It's not that central bank sovereigns and large institutional buyers were looking for lower prices to buy physical. These Fed-induced dollar index to gold FX interventions provide them a stealthy window to sell and exchange bonds and the dollar for NSFR-compliant physical gold into which they are assured T+1 supply. Now, we figured it would take a few sessions to blow back on the Fed, which it usually does. But just like it did into options expiry in February, March, April, May, and June, now we're seeing the same in July. It will actually physically blow back on the Fed. Now, we still have another day to go to options expiry. So this has happened just a day or two earlier. So always a bit skeptical of there may be a few more little desperate attempts to get these derivative bets into line. But really, we're seeing this as now a very strong physical support level. Ironically, because central bank sovereign buyers are focused on swapping as many dollars for gold as possible so as to participate in the upcoming October BRICS currency launch and are insensitive to prices sub 3,000, even if the deliverable spot gold price has been driven higher by naked short CTA actors chasing the gold price higher, as they have in each instance and every single month since, these useful fools have been assisting in raising the support range of each synthetic wash and rinse cycle, each time rallying from a higher stair step.
So looking at these footprints that we've just seen, it once again showed a weak Fed hand. And this is the point we're trying to make. Now, we'll look at more of that in a second. But what we need to do is underscore that if a central bank wanted to sell a few tons of gold, such as Kazakhstan's 11-ton sales in the second quarter. They sold 11 tons in the second quarter, which was immediately bought directly by Poland, who bought 10 tons, Turkey 6 tons, India 4 tons. Czech Republic 3 tons. In other words, when these sales come, they are more than taken up directly by another central bank. So, and we've seen it when the IMF sold gold to India at 200 tons. In other words, what we're trying to say is this is central bank to central bank. Now, we've seen all of those 11 tons we just talked about in fact, 2 months ago in May, when we saw this rally going on. Now, it's always the case, and this is the point I'm trying to make, when a central bank sells, in order to get the best price and to not discount the market, these transactions get bilaterally settled directly between another central bank off the market, but at the market price. And we've got plenty of evidence that any excess bullion that comes on sale is directly sold into the Sino-Russia alliance in largely unreported monetary gold form. Now, liquidity providers report that the PBOC welcomes these exchanges of dollars for gold with wide open arms, negating them to report official market purchases. So put this reality into context with the impossible to supply 467 tons of COMEX synthetic gold that was dumped all at once at the market price. In other words, creating an air pocket directly after the highs that we showed you were struck on Wednesday, the 17th. But what they did was first they waited for London, Europe, and all other markets to be closed. You have to give your head a shake. This so-called sale constituted close to 30% more bullion than China produces in a year. And while gaslighted, siloed COMEX traders accept these sales at face value, even they should realize that this kind of size would not be dumped all at once into the most illiquid conditions after a gold fix. Of course not. Now, what we witnessed was the Fed actioning their historical modus operandi namely waiting for sufficient naked short CTAs, the paper traders and the COMEX basically. They were enough long CTAs to build before creating a waterfall event. And they can do that because they have position concentration. Now, these CTAs have been coattailing a strongly rising physical gold price being set outside the LBMA CME ring fence, driven by an accelerated move by the Sino-Russia BRICS alliance to de-dollarize into gold before the early fourth quarter BRICS gold currency launch. And, of course, then that follows the US elections.
Now, using the thinner conditions last Friday and 2 further short sales, and look at the timing here, Monday, 2:30 a.m., Tuesday, 2:30 a.m. And what they're doing is pulling bids there. They're not adding shorts so much as pulling the bids in illiquid conditions. Now, every single CTA long that was added here from 2383 has been rinsed out. But in the process, it's carving out this higher stair step we're talking about. Interestingly, last night's 2:30 a.m. attempt backfired. And because it had run into very strong Indian, Saudi, and SGE physical bids, indicating a bullish change in behavior. Any further momentum-driven selling will be naked short, with insiders exposed to the physical markets on the long side. Of course, by design, the Wednesday through Thursday, this is, of course, this is where the COT cutoffs are. And of course, the only report we have is from Friday. And so basically, you can see here that all of this action, and it never is, always the major action happens after a COT cutoff. None of it was captured in the deliberately delayed COT report, which you're going to have available to you on Friday. Here, the new one will be available on Friday when this episode is published. So really, to sum up the very short-term action into this options wash and rinse cycle, the bid-pulling officials in gold futures have so far been able to suck in the required volume of CTA sellers to offset what can be squared for cash inside the COMEX, alongside a targeted layer of 2,400 spot OCC bets, which I'm sure they have covered. However, these synthetic flows will not have offset the requirement to fully collateralize the 96% unbacked exchange for physicals that do flow out of the NSFR compliant spot gold FX markets into the NSFR compliant spot gold FX markets from the COMEX for physical delivery. This is looking like another officially driven short covering misstep into a constructed attempt at a full gap close. As I say, this will have rinsed out every fresh CTA long and now be reliant on sucked-in momentum naked short selling, into which commercials will be seen to have been adding large longs. Now here's the misstep. This line here is the spot 2400 level. And we ended up with one fix below, so which enabled central banks to lock in another misstep. This is a misstep. And then suddenly, we've seen, even though we've seen 2:30 a.m. sell orders, what comes in is every single morning we see the Asians coming in, the insiders selling, Asians coming in, insiders selling, but this now has somewhat reversed. And this was the first fix sub 2400 since the 11th of July. And it will have forced the commercials on the long side of every capitulation and fresh momentum short. This sets up gold for a higher stairstep, which we have provisionally circled. And these flows will come into for delivery into first notice on next Tuesday, which is when all of the paper positions will have to be fully paid for. In other words, the 4% skin in the game has to become 100%. So what we've discerned is that insiders have been selling the upcoming next liquid month December contract. which I will show here, and again, it's showing another failed gap close. But this is the December contract. It's far more liquid now. This is the next contract that has come into being after tomorrow's options expiry. It's already more liquid, and it's trading at about a $50 premium to the August contract. So what's the game? So insiders have been selling the upcoming December futures contract at a $50 premium versus the soon-to-expire August contract, which by options tomorrow which is Thursday, will jive with spot. Now, footprints in this December contract also evidence a targeted attempt at this gap close and failed. And this was conducted by way of short selling the December contract that was locking in pretty much a $49 premium to spot, but simultaneously creating downside air pockets in the expiring July contract. And that's how they create these air pockets, because what they do is, this is actually the August contract, but it expires in July. So what they do is they do the selling in the to gain a $50 premium in the December contract, and then they hide these exceed intraday position concentration limits, buying back the August contract at a discount ahead of the close to hide their footprints and to escape CFTC oversight. That's the game.
All right, Andy, that's great update on gold, but what are your thoughts on silver in this current wash and rinse cycle?
Now, looking at the outrageously gamed action in silver futures, which also successfully rinsed out every single non-sticky CTA long, we evidenced an overshoot of the cartel's 30.75 sweet spot. So really, their sweet spot is actually all the way up here. Now, the spot 29 level, which is a 17-cent difference in this September contract. So basically, the spot 29 level has been two-way rinsed a couple of times, opening up the COMEX to very large loadouts. Now, as spot silver is not NSFR compliant, the resulting EFPs land in unallocated form and are largely able to be cash settled on the books of the cartel members. Hence, putting deliverable silver future warrants in the crosshairs for physical delivery of bullion they don't have, this is going to evidence insiders exposed to these direct backdoor loadouts to short cover. They're going to have to. There is going to be massive deliveries right from the back door of the COMEX.
Andy, that was awesome. And it definitely helps to explain all of this counterintuitive action as of late. Those price charts you showed really helped to visualize the footprints. So now that option expiration is behind us, how far do you think they can get price to fall before that physical market dog begins to wag the COMEX tail once again?
So as we outlined in our last episode, we'd identified very large central bank bids had reaggregated at the higher 2400 spot level. If you remember, we pointed those out. And while we anticipated a momentum-driven CTA overshoot of this very large central bank, sovereign, and institutional bid level, we also expected these competing central banks to patiently wait for a forced Fed derivative rescue event, which they've seen month after month. You've seen on the charts how February, March, April, May, and June, and now July, each one of those was a wash and rinse options derivative event. Why would you not wait for the next one? That's exactly what they were doing. And that's why I wanted to show you exactly those levels. Now, they were just simply patiently waiting for this derivative rescue that would enable these central banks and sovereigns and institutional buyers who know every tool in the Fed's rapidly shrinking toolbox to just get one more wash and rinse cycle into which competing central banks wait to corner a trap Fed known to be forced to rob Peter, to pay Paul, so as to kick the can further down the road, the derivative can further down the road. Now, the launch of Glasniev's gold-backed BRICS currency will be pivotal. Gold will have to be revalued. We talked about this before. And if the Fed runs casino fails to discover a fair physical price, it's clearly going to be forced to close. Now, a well-connected Chinese contacts aside, the average of multiple credible sources have estimated China's gold reserves constitutes at least 30,000 on the low ball and more likely 40,000 tons of gold, which, to stay off the radar for now, are salted amongst the state-held banks and could be crystallized with a click of a mouse. Now, this conservatively suggests that the percentage of gold that backs the aggregate total of officially reported, as well as SETS's 3 trillion, that's a 6 trillion assessment of China's FX to reserve. Now, that is plausibly close when this is actually realized. It's closer to a staggering plus or minus 40% of backing for the currency. And I mean, really, that would constitute the highest gold to GDP ratio of all the global central banks, multiples of the European gold and to GDP average of around 4%. Now, we've been tracking the ramp up and the potential scale of the de-dollarization process and why, Taiwan escalations aside, it doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries. Now, what's becoming clearer, though, is that China has, through their secretive shadow banking operations, been stealthily converting a large percentage of these hidden 3 trillions of largely dollar FX holdings into physical gold. Now, once this is ultimately revealed, the price of gold will far exceed Goldman and the 5 first-tier banks' estimate of between $2,700 to $3,000 per ounce in 2024, likely placing $2,700 as a floor, which is Goldman's target, as a floor to rally off. Now, if needed to be invoked, the nuclear option would be for the Sino-Russian alliance to announce they're about to or have already announced a revaluation of their gold reserves, which, to avoid a related interconnect currency breakdown in the other global central bank currency crosses, which they're all interconnected, it would trigger every other global central bank to also revalue their central bank gold reserves. And that is a process that we've been through before. It is simply can be done with a click of a mouse. Now, as we previously outlined, this can be affected. What the central bank does is simply sell their existing undervalued gold revaluation account gold holdings. Let's just say at what liquidity providers kind of figure it's likely around $1,900. It's been raised from 12, 13, 14 to about 1,900. That's pretty much where the European central banks are. And then into a bid-only market, immediately what they do is sell it, rebuy the same number of ounces back at market at, say, $2,500 to $3,000, instantly crystallizing a gold asset gain, bolstering their GDP gold correlation, which would be supportive of their currencies. And that would cement a new floor for the price of gold. Now, notably, at this point, every single central bank, without exception, would benefit from a higher gold price. Now, clearly, this process was once and all for eliminate non-Basel III compliant paper gold as a tradable asset class. So, as we previously questioned, so where does this leave the Fed, who, since Nixon withdrew the convertibility of gold for dollars at a fixed price in 71, it remains the only central bank that's continued to bet against gold since Basel III compliance turned gold into a first-tier asset class 1.5 years ago on the 1st of January 2023. Now, as we previously assessed, the only backdoor for the Fed to avoid exposing the degree of rehypothecation of the reported 8,000 133 tons of treasury gold would be to also revalue gold from its current treasury price of $42. Whatever the price, it'd just be done. Whatever the price would be revalued is where the Sino-Russian alliance revaluation price settles. Now, if they don't, every other global central bank would repatriate their gold, bankrupting and exposing the Fed's gold rehypothecation fraud. As we all, and we're not the only ones of that opinion, is that the gold may be in the Treasury vaults, but how many ownership claims are on it? That's the problem. But as of yesterday, the heat turned up on the Fed. In a race alongside every other BRICS bank to secure as much gold as possible ahead of the October BRICS gold-backed currency launch, India has cut gold import duties from 15% to 6%, alongside, for the first time since 1990, repatriating the first tranche of 100 tons of gold from the Bank of England. Now, and more to come. They're going to repatriate every ounce. A move to repatriate Indian gold reserves stored at the Federal Reserve, good luck with that, is reportedly underway. Now, this repatriation request will cause a problem for the Fed, who will either drag its feet, perhaps try applying political pressure, or they're just going to have to go to market to buy back the bullion. Maybe all those things. Now, one way or another, this is bullish for gold. What it's doing is drawing attention to first-tier physical gold being segregated from high counterparty risk ETF and derivative gold. Now, India's onshoring is just one more move by all the global central banks to repatriate their gold ahead of the BRICS currency launch. Repatriating gold is a major component of the race to de-dollarize into rising geopolitical escalations and the associated sanction risks.
Andy, that's great stuff. Thank you so much for that update. What else are you seeing at this point?
Well, looking at the very bullish larger picture and completely missed by the siloed CTAs, central banks, and institutionals, they're beginning to discern the reason that the bond dollar index, the bond dollar gold correlations have been turned on their head and is beginning to dawn. How can you ignore it? Now, Bank of America Hartnett is an institutionally followed analyst. Now, he's got no skin in the gold game. His opinion is, in this latest piece, he picks up on the absolute breakdown of the bond to gold correlation. Now, what is of note is his take, and clearly the view of other first-tier banks and central banks, is that gold is an indicator for bonds, namely that gold is increasingly predicting bond market movements. In other words, since FX gold became Basel III NSFR compliant on the 1st of January 2023, deliverable FX gold has increasingly been competing with fiat-backed US Treasuries. And as we now progress through the second half of the year, the lines have crossed where physical gold is now sufficiently liquid enough to predict bond behavior, not the other way around. This will accelerate both the de-dollarization and the revaluation process. Bottom line, summing up his long piece, now that is available to premium subscribers on Zero Hedge, it's there. Hartnett acknowledges that India and BRICS countries are stepping up gold purchases, regardless of price. That is the point. To provide, what they're doing is providing collateral for the launch of the October BRICS gold-backed currency. These game-changing bullish for gold drivers are slowly becoming mainstream. Now, this tectonic change in structure has been driven by Global South's BRICS and newly joining members selling bonds and converting these dollars into physical gold at any price to bolster their currencies with as much gold as possible, so as to be able to participate in the rapidly approaching October BRICS gold-backed currency launch. So even putting aside the race by the multipolar-driven Sino-Russian BRICS alliances to sanction-proof themselves into an increasingly hostile unipolar-driven environment, given the Fed is printing $1 trillion every 100 days to avert bankruptcy, and these bond offerings are backed by faith alone, is it any wonder why central banks, sovereigns, and institutionals want to switch first-tier asset horses from US Treasuries into physical gold? The next step is for the BRICS to open its own parliament, and there's an announcement on this upcoming. All of these bullish for gold drivers appear to go unnoticed by many COMEX-facing analysts who myopically view the synthetically constructed historical trend lines, which by design result in monthly technically overbought conditions being synthetically sold into. And we've shown you multiple examples of that. But these siloed analysts miss the fact that the 4% backed gold price is no longer actually trading in correlation with the dollar, bonds, etc., because outside their siloed world, the fully paid up bullion being settled in the far more liquid Sino-Russia physical exchanges consistently trades at a very large premium to the LBMA CME diluted prices. Also, it still also amazes me how the bulk of Western-facing traders accept the COMEX COT reports at face value. We've looked at them before, because by design, it's currently geared to spook traders who would then, as we see these reports start to look bearish, they start wringing their hands over the largest net short bullion position that has built up since April 2022. Obviously, that is by design. And that was when gold was trading at $1,900. And basically, COMEX open interest had topped out at around about 650,000 lots. It used to be 800,000 after COVID. Then we had a big capitulation, and then they rose up to 650,000 lots. Now, so immediately you look at that report, you don't look at anything that's related to that report, and you think there's going to be a rinse. Yeah, okay, a little bit of a rinse. Perhaps you pause and wait for that discount. But what is missed by these traders is that since Basel III NSFR regulations were imposed in January 2023, these COMEX commercial positions, they largely reflect the short hedging leg of a fully compliant long FX gold position. It has to be compliant. So by design, the intent for these market-making swap dealers, for example, they use this large concentrated positioning to pull bids so as to trick out paper long CTAs who have borrowed this open interest, the chips in the casino, from these banks holding the loan book on these borrowers. They know the exact margin call pain point to rinse them out of their 4% long bets. And they are quick to race out. And as we've demonstrated, usually at the most illiquid times of day, generally after Asia, London, Europe have cleared for the day. However, this game has become far too well known and is being capitalized on by central banks, sovereigns, and institutional physical buyers, converting these synthetic prices by way of outflows of COMEX EFPs. That's the back door to the COMEX and related spot gold fixed benchmarks, which allow them to alchemize these paper discounts. Now, this means that these once COMEX-centric wash and rinse cycles are actually limited to how many CTAs they can square off inside the COMEX before they expose themselves to T+1 real delivery obligations they cannot fulfill. Hence, the higher lows and highs are being disciplined by the global physical markets, where active physical buyers are insensitive to a price sub 3,000. Their focus is to de-dollarize. In fact, I say $3,000 is conservative. Put yourself in China's position. They still have 3 trillion in US dollar reserves, shadow banking reserves, as well as 3 trillion in official reserves to convert into gold. So far, it's not suited them to pull the financial nuclear option of selling dollar-denominated bonds. This would easily drive the gold price to $10,000 But it's a case of actually be really careful what you ask for if you don't own enough gold to offset a major global banking collapse. And Peter Grandish was very, very, very explicit about that. Be careful what you want. So just a quick note on, I think, last Friday's deliberately delayed COT report, because I know that is one of the questions. I know that Shane is not so well, so I know this was one of the questions. So into the gold, there was a $99 rise in price between the two reports. And obviously the new report is not yet published. I'm talking about the ones that are published. And then we saw 63,000, lots of fresh open interest arriving, another 60 odd thousand. We saw 125,000 thousand lots of chips being added. Again, so we saw the insider, agent, bank, swap dealers, and producer merchants once again, they one-to-one took the short side of all of the 27,000 lots of hot money CTA longs. And given that they were facing massive, very real T+1 delivery obligations, they clearly knew the Fed was planning to intervene and coordinated with the Fed CTA long rinse. Now, obviously, there are two legs to every trade. So it's not rocket science to see that of the 150,000 longs that have been added from the low 2300s, we looked at that on the charts, and picking up volume after 2345, it was put in the rear view mirror on the 3rd of July. At least 125,000 contracts of the last 2 weeks of CTA long stops were rinsed out. And while open interest will appear not to have contracted to the same degree, the difference is the addition of CTA momentum naked shorts, which will be subsequently rinsed after options expiry. So it's quite a different story in SI, though, in silver futures, which evidence very large hot money capitulations. However, the dips sub $31, especially below $29, will have commercials on the long side sub their 30.75 sweet spot. Look, I've tried to squeeze in as many questions as I could in the short time we have. Now, please let us know if you want more or less of these charts in the future. Now, the only remaining question, though, guys, yes, it's Robert Kiyosaki's. It's your friend. It's yours, Robert. How much physical gold and silver do you own? And as Rob Keane said last week, the window to buy bullion at any price, is now. And it may close in October.
Andy, that was terrific. And I know everybody watching really appreciates all the time and effort you put into bringing this information to us. And that's going to do it for this week's Live from the Vault. Hey, on your way out, again, please hit that like button, that subscribe button, as that really helps us cast a wider net of distribution. And, oh, hey, Shane, get better soon, brother. I want to get you back in this seat doing your job as soon as next week. And for all of everybody else, come back next week for another great edition of Live from the Vault. Thanks for watching, everyone.